Question 4, partnership, fixed assets, ratio analysis and interpretation. In this exercise, two of the important things which we're going to do is to complete the fixed asset note to the balance sheet and prepare the asset disposal account for the sale of the equipment. This exercise is divided into parts again, and we're going to do 4.1.1 and 4.1.2. So they give us the information from last year and the balance sheet, an extract of the balance sheet for this year. As you can see, fixed assets at carrying value last year, fixed assets at carrying value this year. And then they give us some additional information which is applicable to note number 3. And then they give us a capital account of the partners, the balances for or the totals earned by each partner, the balances on current account, and some of the financial indicators and the net profit for the year. In this exercise, we're going to start off with note number 3. What you need to know with note number 3 is that there's a few things you can do beforehand. For example, these two, if you take this one, subtract this value, you will get that answer. Even before we can start filling in, we can add a few values. So we can take the 450,000 and we can subtract the 180,000. That gives us 270,000. So we can fill that in without even doing any form of reading on the additional information. What we also know is the following. The value over here, the 270,000 Rand, and the movements here is going to give us the carrying value at the end of the year. That we know. So at the end of last year, we ended off with the equipment at 270,000. This year, at the end of the year, we added, or our equipment is 265,000. So it went from 270,000 down to 265,048. So what we can do, we can take the 270,000 minus 265,048, and that gives us 4952. So we know this movement is 4952. In brackets, it's a negative movement because it was worth 270,000. Now it is only worth 265,048. We know that the additions are always a positive here. We know that the disposals always at carrying value is a negative. We know the depreciation is always a negative. Same goes for the others. Therefore, we can complete as far as possible without reading the additional information. We can't complete this part here because we're missing these values down here at the bottom. But this is what we know for the equipment at this particular stage. Let's go to the additional information and read through the additional information. Depreciation is as follows. Vehicles 15% per annum on the cost price, which means it's a cost multiplied with 15 divided by 100. Equipment 20% per annum on diminishing balance method. So we know it's a cost minus accumulated depreciation gives us book value times the 20 over 100. So that's the difference between the two methods. During the year, an invoice received from Red Construction for 600,000 Rand for the addition to the buildings. And here, August 31, equipment was traded against new equipment, which cost 100,000 Rand. So this is the new equipment. But we traded this at a loss of 12,160. Equipment was bought on 1 March for 80,000. Total accumulated depreciation on the date of sale amounted to 33,930, which means all the depreciation throughout all of the years was already calculated. Let's skip this one and this one for now. We're going to get back to it. During the year, an invoice was received from Red Construction for 600,000 for addition to the buildings. So we know that land and buildings additions, we can put there 600,000 Rand. That we know. Nothing about land and buildings, so we can complete land and buildings. So the movements, the total movements for the year was 600,000. So we can take the 402,931 plus 600,000 gives us the carrying value at the end of the year, which is 1,002,931. And that would also be 1,002,931 there. Because the cost price minus accumulated depreciation, which is not applicable to land and buildings, would give us that value over there. Let's quickly run down through the vehicles. It says there 15% per annum on cost price, which means it's cost multiplied with 15 divided by 100. If we take a look at the cost price of the vehicles, the cost price, which was the start of the year, was 1,080,000. There was no other additions. This is equipment. This is land and buildings. This is how we calculate the depreciation. So therefore, there was no additions to any form of vehicles. So we can take the 1,080,000, multiply that with 15, divided that by 100. Gives us 162,000 Rand. However, this is the problem. Carrying value at the end of the year is only 160,000 Rand. So we were on to write off 2,000 more than what it's actually worth. When we get to this point, the vehicles will only, or the assets, no matter if it's vehicles or equipment or whatever, this asset will be shown as 1 Rand. So the carrying value at the end of this year will be 1 Rand. The assets cannot be shown as 0 value. So therefore we allocate 1 Rand. Now the value, the carrying value at the start of the year was 160,000. And if the carrying value at the end of the year is only 1 Rand, then it stands to reason that your depreciation will be 159,999 Rand. Because your assets can never be shown at 0. And we cannot subtract 162,000 Rand. So we can only subtract up to the amount of 1 Rand. In this case, we can only subtract 159,999. And that is the vehicles. Let's go to the equipment, because that's the only one that's left over. Before we complete the equipment, let us complete the sale of assets. In the sale of assets or the asset disposal, they literally give everything for us. So this would be August 31st, 2014. Equipment which cost, traded in against new equipment which cost 100,000. The new equipment or the equipment was traded in was bought on 1 March for 80,000. So we're going to have here the word equipment. Comes from the General Journal, and that reads 80,000 because that is the equipment we got rid of. Then, still also on August 31st, the accumulated depreciation on the date of sale, that's important. We don't need to work out anything else, amounted to 33,930. So this would be accumulated depreciation equipment General Journal. Then traded against new equipment which cost, nowhere does it say that we got cash for it or whatever. We traded in for new equipment of 100,000 Rand. So we can write here creditors control CJ. We don't actually know what that amount is. So that's going to be a balancing amount because they give us the loss. So we're going to write here loss on sale of asset, General Journal, and it is 12,160. So and they said we've got a book value of 33,930, and we sold it at a loss of 12,160. So we've got everything here except what we sold it for. All that we need to do is to obtain that missing amount, and that's a balancing figure. Because if we add up this side, 80,000. This side and this side has to add up 80,000. Only thing that's left now is to work out the missing amount. So we've got the 80,000 minus 12,160 minus 33,930 gives us 33,910, which means we sold it to them for 33,910. Therefore, we can put in the disposals. At this particular stage, disposals is usually at carrying value. In this case, that would be there, the 80,000 minus accumulated depreciation of 33,930. So if we take a look, 80,000 minus 33,930 gives us a book value of 46,070. So that would be the disposals. All that's left is to work out depreciation for the year and the additions. Part of this note says, against new equipment which cost 100,000 Rand. Additions, equipment, 100,000 Rand. We don't need to go and calculate the depreciation for the year because most of us has been filled in for us already. We know that this amount is 4952 as a negative. We know this amount. We know this amount. We can go and work out this amount here. We know that was 100,000 was the amount there. We have to subtract the 46,070. That leaves us with 53,930. But we know that that must be negative 4952. So we're going to put there 4952 gives us 58,882. 58,882 in brackets. So let's take a look if this works out. So we take 100,000. We subtract from that 46,070. And we subtract from that 58,882. Gives us negative 4952. Last but not least, we have to complete this particular one. We had the cost price, which is still the same because there was no movements here. There was no movements except for the depreciation. There was no additions. There was no disposals here. So that should be 1080,000. We do have the cumulated depreciation, which we forgot to start at the start, which would be the 1080,000, and we left with 160,000. So the balancing value there would be 920,000. So we can take that 920,000, add to it 159,999, gives us 107,999 in brackets, because we know that that value minus that value gives us the R1 over there. And this concludes question 4, the first part.